Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. Perhaps most importantly, it is now fall, and so the vest has come out. Will probably be with us for about the next 6 months if you're a regular watcher of these programs. S&P 500 right at about 5733 as I'm speaking. That is up about 21% year to date. Market pretty close to all-time highs, only a couple of points shy on the S&P 500. As we continue to ride this sort of, Goldilocks scenario wave that the Fed sort of produced in the middle of the month in terms of a large interest rate cut followed by about 2 years of return to normal, commentary on strength in the marketplace, just a lot of very sort of rosy environments for stocks. Would also note that the 10-year Treasury is at about 3.75%. That is up about 15 basis points or, 0.15 of 1%. That's up about that level off the low from mid-September of about 3.6%. Once again, I think the Fed speak there sort of reverberating, giving us a big cut on the front end and then about 2 years to get down to that normal rate. That's probably a little slower than the market was looking for, and so you've seen the 10-year creep up a little bit as a result. Would also just note that, we're sort of closing out the third quarter, entering into the fourth quarter. Feels like a good time to kind of look back at the year. S&P 500 continues to be probably one of the global best asset classes out there. That 21% number is up, quite a bit versus a lot of the other comparable indices. And in particular, the two that like to get picked on the most are the Russell 2000, which is small and mid-cap stocks. That's up about 9.75% year to date. As well as international stocks. So the ACWI ex-US up about 17.3% year to date. Those performances are still trailing, the S&P 500. However, if you look back at the third quarter, they've made up a little bit of ground. And so it's actually, very interesting to see when we get those types of movements for the third quarter, the S&P 500 up about 5%. International stocks up about 6.5%, and small and mid-cap stocks up about 8.5%. So gaining a little ground, those two areas of the marketplace, kind of liking what they're seeing domestically for the small and mid-cap space, lower interest rates, and this sort of Goldilocks environment, a very positive environment for small and mid-cap stocks. And then internationally, you've got some currency movements going on, as well as just strength in other economies that are really driving a lot of performance there. So an interesting reversal a little bit during the third quarter. Last but not least, we have this looming U.S. port strike all around the East Coast that is starting to make a decent amount of news. For those of you who are not aware, you can probably go Google port strike. You will see a lot of information about shutting down basically every port on the eastern and Gulf Coast of the United States. That's obviously a bad thing for trade, and there are some people that have, I would say, some very draconian or, terrible views of what that means in terms of, we're going to have shortages and go back to the sort of scarcity factor that we had during COVID. I don't know that that's going to happen or not. The Biden administration does have the ability, if it wants to stop a strike. However, given that they have a lot of union presence in their sort of political base, they don't like to quash the ability of laborers to strike. So they're in a little bit of a bind there. They don't want to have to step in. But they certainly don't want the strike to go on for, if it does happen, to go on for any material period of time. So we will just have to see how that all shakes out. In terms of how the markets generally react to stuff like that, I would just note that the market is very, very forward-looking. It tends to look over these types of strike events or any of these types of things as kind of one-time impacts. It really doesn't impact, your expectation for sort of 2025 earnings or 2026 earnings. And so typically when the market sees something like this, it just kind of shrugs it off and moves on forward. So, you may want to run down a target and make sure that you've got your supply of toilet paper and maybe wrapping paper for the upcoming Christmas season. But I wouldn't be too worried about it with regard to your investment portfolio. It's likely to have a more close to home impact than an impact on your statement. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you are having a great day, and I look forward to talking to you again soon.